If you have money in the markets, you're gonna wanna watch this video. There's been a lot of volatility lately. It started when Trump restarted tariffs on Mexico, Canada, and China, which sent stocks falling. Then Trump announced a US crypto reserve not long after creating the United States Sovereign Wealth Fund, which has investors confused as to how we're gonna fund all of this. And then we have the icing on the cake. The Federal Reserve Bank says that the United States economy will probably shrink in the first quarter of 2025. All of these changes have made stock market investors nervous, to say the least. But this year I want to do something a little bit different. I want to use this video to talk about how all of this creates opportunity as opposed to fear, because unfortunately, a lot of people love selling you the fear. And I'm going to do that by going over 5 things. Number 1, I want to talk about history, because while history doesn't exactly repeat itself, it does rhyme. And we've seen similar patterns happen in our markets before. Number 2, I want to talk about how you can weather the storm. And then number 3, I want to talk about how you can win through all this craziness. Where do you find the investment opportunities? Number 4, I'm going to talk about how you can use your money right in this type of economic environment. And then number 5, I'm going to talk about the trap that causes a lot of investors to lose money. So I highly recommend you watch this video until the end. Let's start with a little bit of history, because we've seen similar things happen in our economy before. Let's go back in time to the early 1970s, when the United States government was facing a lot of financial problems. The United States government had a lot of bills to pay, but they didn't have the money to pay those bills, and so the United States government was on the verge of bankruptcy. Now that might sound a little weird in today's economy, because you might say, can't the United States government just print the money and then pay off their bills? Well, yes, today they can, but they couldn't then. Because back in 1970, our money was backed by physical gold. Our dollars were backed by a precious metal, physical gold. So if the Federal Reserve Bank wanted to go out and print more dollars, they needed more collateral, more physical gold, to justify that money printing. We didn't have that. So to fix this problem, then President Richard Nixon in 1971 took the United States dollar off of the gold standard.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
This meant that our paper money is no longer backed by physical gold, and so now the United States government can work with the Federal Reserve Bank to print a blank check. And that's exactly what happened. The Federal Reserve Bank wrote the government a blank check. The government then paid off all their bills, and we avoided bankruptcy. And so this solved the economic problem in 1971. But then it created a new problem. The second problem that we had from all this government spending was inflation. It led to the super high inflation rates that we saw in the late 1970s. Now, to fight this inflation crisis, which was caused by the Federal Reserve Bank printing a whole lot of money for the government to spend, the Federal Reserve Bank stepped in again. Now it was a guy by the name of Paul Volcker, who was the chairperson of the Federal Reserve Bank, who raised interest rates significantly. He took the federal funds rate up to around 20%. As a way to fight inflation. Now, to put those 20% interest rates into context, the interest rates that the Federal Reserve Bank has set for today is around 4.25%. So 4.25% today, 20% then. This move to raise interest rates by the Federal Reserve Bank in the late 1970s and the early 1980s brought the inflation rate down.
To break the inflation cycle, we must have credible and disciplined monetary policy. And it worked. Inflation fell quite sharply. You can see from 1980 to 1983, inflation fell all the way down to about 3%.
So it helped fight the inflation problem, but it then had another consequence. And the other consequence was economic pain. It ultimately led to the painful early 1980s recession. So why am I telling you the story? Because while history doesn't exactly repeat itself, it does rhyme. In the early 1970s, it went from a lot of government spending, which created an inflation problem, which led to the Fed raising interest rates, which then led to some economic pain to solve that problem. Well, what are we seeing today? We had a lot of government spending, which then created a lot of inflation, and then the Federal Reserve Bank raised interest rates, not as aggressively as we saw in the 1970s, but aggressive based off of today's standards, and that is now leading to confusion in the economy. But we have some changes now. For example, the Trump administration is talking about cutting taxes while also reducing government spending. So now that you understand that, let's move on to number 2, weathering the storm that we're seeing right now. And I want to remind you, we're seeing a lot of changes happen in our economy very quickly. And these changes also create some investment opportunities, which is why on March 11th, 2025, I'm hosting a free workshop where I'm going to be going over all the changes that we're seeing happen in our economy, from Doge to AI to tariffs, and how these things create unique investment opportunities. It's a free workshop, but you do have to register because I'm doing it twice on March 11th, once in the morning at 10:30 a.m. Eastern Standard Time, and again in the evening at 8 p.m. Eastern Standard Time. So if you want to join me on this free workshop, you got to save your spot because we have a limited number of people that can join me live, and I have the link for you to join down in the description below. Here's a fact about our economy that people try to forget. Recessions happen. They are a part of our economic system. In fact, over the last 100 years, do you know how many recessions we've seen? It's not 5, it's not 10, it's not 15. It's 16 recessions over the last 100 years. And over the same 100 years, we have seen 25 bear markets. That's 25 downward stock market movements where the stock market has fallen more than 20%. Recessions are a part of our economy. They are the way our economy works. And many people forget that that happens. And every time that recession happens, two things happen. Somebody gets wiped out and somebody gets rich. And in order for you to actually build wealth during those periods of economic pain, you have to understand the system. And that starts by understanding the different ways that you can actually win. Now I'm going to talk more about that in number 3, but speaking more of weathering the storm. We don't know what's going to happen tomorrow. We don't know what's going to happen next week. We don't know what's going to happen next month or what's going to happen over the next 12 months or the next 3 or 4 years. We could see a recession. We could see an economic boom. I'm not here to predict because nobody knows. But what I do know is we will eventually see a recession, and you want to be able to weather that storm whenever that happens. And this is where I want to remind you that every time there's a loser, there's also a winner. For example, if we take a look at what's been happening in the stock market just over the last few weeks, we saw the news of the stock market falling. We had all the news of cryptocurrency prices falling. But when that was happening, when stocks and crypto was falling, do you know who was winning? Well, gold prices were going up the same day that stocks and crypto were crashing. Not to mention, we also got news that home prices were also going up during the time where stocks were crashing, during the time where Bitcoin and crypto was falling. This is where, if you are an investor, real diversification can be very useful. But this is the thing that so many people get wrong. Now, I get it. I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But when I talk about real diversification, I am not talking about diversifying your money in your stock portfolio. This is what most people think about. They say, I have a growth fund, I have a blue chip fund, I have the S&P 500 fund, I have an innovation fund, I have an international fund. So doesn't that mean I'm diversified? Well, if the stock market crashes, chances are all your funds are going to be hit. So that's not real diversification. Real diversification is having investments in multiple different asset classes. I'll show you what I do. I don't recommend what I do to anybody else, but I'm just going to show you to kind of help you think like an investor. I invest my money in 5 places. Number 1, my largest investment is into my own business, Briefs Media. Number 2, I invest money into physical real estate. Number 3, I invest money into stocks. When I say stocks, I mean passively into stocks and actively into stocks. It's almost 50-50. Passively into stocks means into my portfolio of funds that I want to invest in. Actively means when I'm looking for individual companies to invest in. Number 4 are my speculative investments. These are the startups that I invest in and the cryptocurrency that I invest in. I say speculative because, well, they can go up very quickly, but they can also crash just as fast. It's a smaller piece of my portfolio, and so I understand it's more on the speculative side as opposed to more of the proven side. And then number 5, I own a little bit of physical gold. It makes up about 2% of my total portfolio. I don't look at this as a traditional investment per se. This is more like an insurance, doomsday protection. My theory, and this is just my theory is that if I took $10,000 worth of cash today and $10,000 worth of physical gold today, buried them both in my backyard, and then dug them up in 10 years, I believe that the gold will have more buying power than the cash just because of inflation. Do I know for sure? No, but that's why I have a little bit of gold as my diversification and insurance. For me, I call this real diversification for me because in 2022, when the stock market fell by 20%, this got hit very hard. But real estate prices, rental rates were booming, so this was going up. In 2020, when the stock market was crashing at the fastest rate ever, crypto prices were crashing at the fastest rate ever, real estate prices were still going up. When the 2008 housing market crash happened, real estate prices didn't bottom out until 2012. So real estate prices kept falling until 2012. That was the worst period of real estate. But in 2012, the stock market was booming during that same year. So if you want to be able to weather storms, because storms are going to happen in the future. Yeah, we're seeing a little bit of volatility, but we haven't faced a real storm in a while. When that storm happens, if you want to be able to win through the chaos, through the craziness, having some real diversification can help. You don't have to copy me, but you can find something that works for you. I should also mention that in 2020, when all the craziness was happening, gold prices were also going up as well. Now that you understand how to weather a storm, let's talk about how you can win when you see the craziness, when you see the volatility. And this is where it does help for you to stay up to date on what's happening in the financial markets. And my team at Briefs Media also publishes a free daily newsletter called Market Briefs, where we break down what's happening in the financial markets. It's completely free. If you have not joined Market Briefs yet, I have the link for you down in the description below. There was one common trait between the 2022 stock market crash, the 2020 pandemic meltdown, and the 2008 global financial crisis. Do you want to guess what that common trait is? Here's a hint. I said it a little bit earlier in this video. It is that some people got wiped out and some people became very rich. When most people talk about downturns or recessions, they talk about the bad side. They talk about how it creates bankruptcies, how it creates foreclosures, how it creates a lot of economic and financial pain, which is true. But on the flip side, that very few people understand, only the financially savvy understand this, is that it also creates opportunity. Because when markets go down, it creates a buying opportunity for you to come in and buy a great investment at a discounted price. But you have to know how to be able to find and analyze that investment, and you have to know how to have the money, which I'm going to talk about in number 4, to actually take advantage of that investment. But if you want to be able to capitalize on it, you have to be able to think a little bit differently, not get caught up in the whole emotional sensationalism out there. Now your question at this point is probably, well, Jaspreet, how do I find that opportunity? Well, what I want you to look for when you see that craziness is poop. P-O-O-P, poop. Poop stands for panic, leads to overselling, leads to opportunity, leads to profit. Look for that panic and overselling of a good asset. Now, I'm not going to go over how to analyze an investment in this video. I'll be going over that in my workshop, and I have a bunch of videos on my channel where I go over that. But when you're looking for the opportunity, you want to find where you see a good investment opportunity at a discounted price. That way you can come in and buy. And this is where it's also very important for you to know the strategy that you're playing when it comes to you investing your money. The mistake that a lot of people make is they say, I'm going to be an investor. Now you go into Reddit, you go into Google, or you look for what a random person on the internet says about what stock you should buy. And that's why most people end up losing money in the markets. It's because you don't have a strategy. Because then as soon as the market starts to go down, well, you start to panic sell because now you don't know if you made a good investment or not. And this is where your strategy is so important. For most people, the best thing to do is just to be a passive investor. And by passive investor, I mean this. I'm going to give you another acronym. A-B-B. Always be buying. As a passive investor, now what you're doing is you're not trying to find the next Tesla, the next Amazon, the next Nvidia, the next whatever. You just want to own a piece of the American economy. And when you just want to do that, you don't have to stress about what's happening in the markets. You don't have to stress about the day-to-day. You don't have to stress about any of the craziness happening. All you have to do is make sure that your system is working and you're always buying. And when I say always, always means always. It doesn't matter who's in the White House. It doesn't matter what's going on with tariffs. It doesn't matter if it's raining. It doesn't matter if it's sunny. It doesn't matter if it's a recession. It doesn't matter if the economy is booming to new record highs. Always means always. And you set a system maybe every week, every 2 weeks, every month, where you always are buying. I have my system set up, so I buy every week. I do it on Wednesdays just because it's in the middle of the week. There's no secret science as to why Wednesdays. Then I have my portfolio of funds that I want to invest in. Most of my funds are paying cash flow. They're paying out dividends because I like that income. It's just something that I like. And so now I have my system set up. Every Wednesday, I'm buying no matter what. The flip side is I'm also an active investor. This is now what I say most people should not be doing, but it does create some opportunity. It comes with more risk, but more potential for return for the right investor. An active investment is now you're looking for a market shift. That's what I look for. Where is the money moving? Where is the opportunity moving? Because I want to know what's going to be worth a lot more in the next 5 or 10 years. Now, what industry is dying? I don't want to invest into a dying industry. I want to invest where the money is moving. Well, this is where I look for market shifts. This is where I'm looking for the opportunity. Where is that opportunity going to be? And then I'll look for a good opportunity in that shift. If I believe, hypothetically, that artificial intelligence is going to be a big thing in the year 2030, 2040, and we see a crash in some great artificial intelligence stocks, well, that could create a potential buying opportunity. If I believe that some healthcare company is going to be big in 2030, 2040, and they get smacked through fear and panic, and I believe it's a good opportunity, well, that can create a good buying opportunity for me. But this is where number one, I need to know the industry, that I believe money is going to move into this industry. And then number two, I have to believe that this is a good company that's analyzing the company, looking at the CEO, looking at the financials, reading the earnings statement, doing a valuation analysis to understand, is this company overvalued or undervalued? I want to buy it when I think it's undervalued. There's no secret science to how you do this. It's just a ton of work. Some of you will love it, others of you will not. And you have to know what's the right game for you. If you don't want to put in all the work, that's fine. Just be an ABB investor and let the market do the thing, let the emotions do the thing, let people freak out. You just always be buying, and this has been a proven strategy to win decade after decade after decade if you are a long-term investor. And now you can just sit back, relax, and let the people freak out. So the way you win as an investor is you got to know your investing system. Are you going to be an active investor or a passive investor? If you're a passive investor, you just ABB, let the markets do their thing. If you're an active investor, look for the poop. Go to the poop. Now, let's talk about how do you get your money right. Let's play through an example. Let's assume that you see an amazing investment opportunity today. You find the most amazing investment at a very good discount and you want to buy it. Well, what if you don't have any money to buy? That investment opportunity doesn't do you any good. You can have all the financial education, you can have all the research, but if you don't have the money to buy, you can't actually take advantage of it. And this is where you gotta know how to systemize your money. That way you can protect yourself through craziness, but also capitalize on opportunities. See, it's a 1-2 punch here. And this is where a simple thing that you can do is follow something like a 75, 15, 10 plan, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. Now, you're doing a couple of things. You're protecting yourself because now you always have money to save and invest no matter how much money you earn. If you get a $10,000 bonus tomorrow, well, you know what to do with that money, because most people would say, ooh, I made some extra money. Let me go to the Rolex store, give me a nice new watch. Let me go to Cancun. Let me do something nice for myself. But wealthy people and the people that become wealthy always make themselves rich before they make everybody else rich. That means they use their money to invest and save before they spend all their money. You spending all of your money makes Rolex rich, it makes BMW rich, it makes Delta rich, it makes everybody else rich except yourself. I want you to make yourself rich first. Now, this is difficult, especially during a time where you have inflation issues, during a time where the economy can be slowing. I get it, it's hard. But here's the interesting thing. If you can do this, you'll always have money to invest. And now, when you have this money to invest, you can decide how you want to invest this money. Maybe you want to follow the ABB strategy. You just take this money and you just invest all of it into the markets. You don't have to worry about it because you're not really into the whole financial space. You're not into the whole paying attention to the markets. That's not for you. Great. Take that money, put it in the markets, ABB, and you let the money do its thing. Maybe you want to be more involved as an investor. You take this money and you put it into a different high-yield savings account that's waiting to be invested. Now, when you see the opportunity, you put that money to work. Maybe you say, I have some debts I need to pay off. I'm going to use this money to pay down my debts. Because that's an investment too. Because if your mortgage is 7% a year and you can pay it off 1 year early, that's a guaranteed 7% return on your money. When you put your money in the stock market, you're trying to get a 10% return. It's not guaranteed. I mean, you could see a 10% return, a 20% return, but you could also see a 3% return, or even a negative 20% return. You don't know. If you pay off your debts 1 year early, well, now that's a guaranteed return. And I should also mention this. If you have any sort of high interest debt, like a credit card debt, a payday loan, you should not even be worried about investing your money into the markets. Right now, the best investment for you is to pay down the high interest debt as fast as possible because those debts are skinning you alive. When you're paying 15, 20, 25, 28% a year in interest to that credit card company, to the payday loan company, you're the reason they get to fly high in those private jets and have those big fancy buildings. And it's all coming out of your pocket. So before you go out and invest in the stock market trying to get a 10% return, pay off those credit card debts and the payday loans, because those things are skinning you alive financially. So if you want to be able to actually capitalize on the investment opportunities, you got to know how to get your money right first. Now that we've covered how to get your money right, we've covered a lot of things. We've talked about now how we have seen similar things play out in the past, where we saw the 1970s, where there was a lot of government printing, which led to a lot of inflation, which led to higher interest rates, which led to an economic slowdown. Could we see something similar today? We'll ultimately see. Number two, if you want to be able to weather the storm, because we know recessions happen. Nobody can time the market, and the people that are trying to tell you that a recession is going to happen or that it's going to boom are lying. They have no idea. But if you want to be able to weather the storm, no matter what the storm is, you want to have some real diversification for yourself, and you can figure out what that means for you. Then, how do you actually win when you see the volatility, when you see the craziness? Well, you can either be a passive investor and just ABB into the markets, or you can look for more of active investments. This is where you're looking for market shifts, and this is where when you see poop, well, that creates a great investment opportunity for you. But in order to take advantage of that, you actually have to know how to get your money right in the first place. You have to have the money to invest in the first place, and well, that's where having a good money system can help. The last thing that I want to go over in this video has to do with what I call the trap. And this is the emotions. The reason why so many investors lose isn't because they don't make a good investment. It's because they caught up in the emotions. Emotions are the enemy of profits for an investor. And the reason why is the media is in the business of selling you a whole bunch of hype. I know this because, well, I own a financial media company, and a lot of the traditional media companies want to sell you either fear or greed, because that's going to get you to click, and that's what's going to make them money. That's why I'm such a proponent for market briefs, because all of our news is in one email, so we don't have to give you all that crazy sensationalism. But when you start to go onto Yahoo Finance or Google Finance or CNBC, and all you see is red, and it's talking about how markets are falling and how Wall Street is freaking out and how CEOs are selling, people can panic, especially if you're a newer investor. I mean, it happens all the time. And so when you start to hear about people selling and CEOs are selling and the Fed says the economy is going to fall and all these things, well, now it's very easy to say, okay, I'm going to sell. That way I can cut my losses. And that's the trap. You got to know your game. If you are a long-term investor, you got to stay a long-term investor. Now, you can change that if something bad happens. If something happens wrong with the company you're invested in, and this company is going to go bankrupt, or they change their CEO and now the CEO is running the company into the ground, or you found something else wrong with the company, sure, sell. But if it's still a good company and the price is just falling because markets are falling, well, that means maybe you want to be buying more, but that requires you to not keep doing what everybody else is doing. I call this channel the minority mindset, because if you really want to become wealthy in this economic system, you can't keep doing what everybody else does. The majority of people are broke, drowning in debt, unhappy, and fat for a reason, because they keep doing what everybody else does. And if you don't want to live like everybody else, you can't keep doing that thing. And when we're talking about money right now, you got to be able to break away from all the emotions, all the noise. You got to be able to find the opportunity. There's a lot of political anger. There's a lot of political emotion. There's a lot of heat. There's a lot of whatever out there. Look for the opportunity. Don't get caught up in the trap. Look at what's happening. Look for where the opportunity is, because that opportunity is what's going to help fill up your bank account, and that's what's going to help you feed your family. Getting angry and leaving angry comments on Facebook is not. So you pick what you want to do. Most people would rather leave the angry comment. I want you to be one of the people that's getting rich. You pick what you want to do, but that's the trap. Don't get caught up in it. And with that, I'll see you on YouTube tomorrow. President Trump is now considering getting rid of the income tax. Take a listen.
As I said in my speech last week, instead of taxing our citizens to enrich foreign nations, we should be tariffing and taxing foreign nations to enrich our citizens.
The Fair Tax Act of 2025 was a bill proposed which would effectively abolish the IRS.